17 purchases retirees regret sounds like a listicle about boats and vacation homes. And yes, boats and vacation homes are on this list. But items 11, 12, and 13.3 categories of financial products sold specifically to retirees at the exact moment of maximum financial vulnerability in their lives are responsible for more retirement shortfalls than every boat, sports car, and second home combined. And the people selling them are legally permitted to earn commissions they are not required to clearly disclose. That is the part of this list nobody includes. Today I am going through all 17, not the cleaned up version, the actual version with the incentive structures underneath each one, the psychological traps, and in several cases, the specific dollar amounts of what these mistakes cost over time. Because the number is not just big, it is retirement ending big. By the way, I built a free early retirement calculator because most of the ones you find online are mathematically wrong. They use oversimplified assumptions about inflation and sequence of returns risk that BlackRock, Vanguard's own institutional models, would reject immediately. Mine uses the same stress testing logic that institutional retirement planners use, and it will show you exactly where your specific plan is weakest. Link is in the description. I only ask for your email to send the report. I do not store any of your financial data. Now, here is the one thing you need to understand before we go through this list. Because without this, each item feels like a separate mistake. With it, you will see the pattern underneath all 17. Retirement is a showroom. I mean that literally. The moment you stop working, the moment the world figures out you have a lump sum sitting somewhere, every category of salesperson, financial product vendor, real estate agent, marina operator, and franchise broker sees you walking through their door. And the showroom is designed deliberately and specifically to make things look extraordinary on day one. The vacation home looks incredible in the listing photos. The boat gleams under marina lights. The franchise presentation is all testimonials and projected revenues. The annuity contract is 140 pages of language that nobody reads. Each of these environments is optimized for one purpose, making you feel on the day of purchase that this is the right call. And this is the trap. Not stupidity, not even greed. The trap is that you spent 40 years saying, not yet. Every time something looked beautiful and expensive, you said, not yet. You built that reflex so deep, it became automatic. And then retirement hits, and your brain finally gets the signal that it is allowed to say yes. And it has absolutely no calibration for what yes should look like, because you have never practiced saying yes at this scale before. Everything on this list looks good in the showroom. That phrase is going to come back every single time. Number one, the vacation home. There is a dream that millions of Americans carry for 3 decades. A little place on the lake, a cottage somewhere on the Maine coast, a condo in Scottsdale, something of your own in a place you love, where you can go whenever you feel like it, where the grandkids can visit in the summers, where you finally become the version of yourself you always planned to be. I understand the dream completely. Here's what the brochure does not say. According to data from the National Association of Realtors, the median price of a vacation home in America crossed $500,000 in 2023. The carrying costs, property taxes, HOA fees, insurance, maintenance, and utilities on a property you are not occupying most of the year run, on average, between 3 and 5% of the home's value annually. On a $500,000 property, that is $15,000 to $25,000 per year, whether you show up or not. But the real problem is not the math. The math is findable. The problem is usage rate. A couple friends of a friend, both retired in their mid-60s, bought a lake house in the Ozarks for $480,000. Beautiful place. They plan to use it every other weekend. Year 1, they went 11 times. Year 2, 7 times. Year 3, 4 times. By year 4, one of them had a knee surgery that made the 3-hour drive genuinely uncomfortable. Their grandkids were in travel sports on weekends. They went twice that year. They sold it in year 6 at a $40,000 loss on the purchase price alone, not counting 6 years of carrying costs running at roughly $18,000 per year. Do that math. $148,000 spent for 6 years of partial access to a property they could have rented at a premium lakefront rental for around $4,000 a week. everything looks good in the showroom. Number 2, the boat. There is a saying, and I did not invent this, that the 2 happiest days of a boat owner's life are the day they buy the boat and the day they sell it. This has been a joke for decades because it has been accurate for decades. A 30-foot cruiser in reasonable condition costs between $80,000 and $200,000 to acquire. Annual maintenance, slip fees, hull cleaning, engine service, winterization, fuel, registration, insurance runs roughly 10% of the purchase price per year. That is $8,000 to $20,000 annually, minimum, on a boat that the American Boating Association estimates gets used an average of about 11 days per year by recreational owners. 11 days per year. A marina operator I read about described his business model with perfect honesty. He said his best customers are the ones who buy boats. His most reliable customers are the ones who already bought them because they keep paying the slip fees even when they stop showing up. Number 3, the RV. A Class A diesel motorhome retails between $150,000 and $500,000. They get between 6 and 10 miles per gallon of diesel. A cross-country trip from Florida to Oregon and back costs somewhere between $2,000 and $4,000 in fuel alone. RV parks at premium campgrounds now run $60 to $150 per night. And these things break. Slide outs, awnings, generators, plumbing, the leveling system. RV repair shop wait times can run 4 to 8 weeks, meaning you might be parked in Albuquerque for 2 months waiting for a part. The RVIA, the RV Industry Association, reports that the average new RV owner keeps their unit between 3 and 5 years before selling. A motorhome that costs $200,000 new might fetch $110,000 4 years later. That is $90,000 of depreciation before you account for fuel, maintenance, or a single campsite. What genuinely fascinates me is why this keeps happening, and it always comes back to the showroom. RV dealers are exceptionally good at selling a lifestyle. The inside of a well-designed motorhome looks like a real home. Granite countertops, flat screen television, full kitchen. You stand inside it and you can see yourself waking up next to a mountain with coffee in your hand. You cannot see yourself on the phone with a repair shop in Flagstaff, explaining for the 3rd time that the slide out still will not retract. Number 4, the dream car. This one is the hardest for me to argue against cleanly, because part of me thinks if you worked for 40 years and you want a Porsche, you should buy the Porsche. But here's what tends to go wrong. It is rarely one car. It is the nice car plus the practical car, because the sports car does not handle January in Minnesota. 2 cars, doubled insurance, doubled maintenance, and then there is the classic car restoration project, which is the most expensive hobby in the world, disguised as a future asset. A man I came across through an automotive forum bought a 1969 Camaro at a Barrett-Jackson auction. Body was solid, engine was not, for $22,000. He planned to restore it with a combination of his own labor and some professional help. 3 years and a number of unpleasant surprises later, he had spent $63,000 on parts, specialty shop labor, a repaint, and a rebuilt transmission. The car was now worth approximately $38,000 on the open market. He had lost $47,000 on a hobby and described the result as a success because the car ran. Everything looks good in the showroom. Number 5, the timeshare. Timeshares are not real estate investments. They are prepaid vacation products with an asset wrapper designed to look like real estate. The resale value of a timeshare is, in most cases, approximately 0. There is an entire industry companies that charge you fees to help you exit your timeshare that exists specifically because the original developers made exiting structurally almost impossible. The average timeshare costs around $22,000 to purchase. Annual maintenance fees average about $1,000 and increase every year, whether you use the property or not. Over 20 years, you will have spent $40,000 to $50,000 in maintenance fees alone on a product with essentially no resale value. The timeshare presentation is always spectacular. The presentation is the product. The vacation is almost incidental. Number 6, the country club or golf club membership. Initiation fees at private golf and country clubs in the United States range from $10,000 at a modest club to $200,000 at elite courses in places like Palm Beach or Pebble Beach. Annual dues run from $5,000 to $30,000 per year. And club memberships are notoriously difficult to exit resignation waiting lists at some clubs stretch for years. If you genuinely play 3 times per week and the club is the center of your social life, that math can absolutely work. But if you join because it felt like the thing retired people do because it looks good in the showroom, you will know within 18 months whether you wanted the lifestyle or the image of the lifestyle. Those are very different things, and only one of them justifies $50,000. Number 7, the too big retirement house. You think the mistake here is buying too much house. Actually, the mistake is buying for a vision of retirement that does not match what retirement actually looks like on a Tuesday in January 5 years in. You plan to downsize. You sold a 5-bedroom family home. But then you thought about guest rooms for the grandkids, a proper kitchen because now you have time to cook, a good neighborhood, a yard for the garden you always wanted. And the downsize quietly became a lateral move into a 4,000 square foot home with higher property taxes, more maintenance than 2 people can comfortably manage, and rooms you vacuum every 2 weeks because nobody uses them. In 15 years, stairs become a genuine quality of life issue. Proximity to medical care matters differently than it did at 63. Many retirees end up selling again at 78 to move somewhere more practical, absorbing 2 full rounds of transaction costs, 2 rounds of moving expenses, 2 rounds of getting settled disruption. The mistake is not buying a nice home. It is buying for the version of retirement you imagined rather than the one you will actually live. In a few minutes, I'm going to walk you through the 3 financial products on this list that the industry specifically does not want me to explain clearly because explaining them clearly tends to end sales. But first, stay with me because numbers 8 and 9 are where the list gets genuinely counterintuitive. Number 8, the home renovation before moving. This seems prudent. You are about to sell your house, you want to maximize the sale price, so you redo the kitchen and remodel the master bath. The National Association of Realtors Cost versus Value Report, which tracks renovation return on investment across the country, consistently shows that the average major kitchen remodel recoups between 60 and 65% of its cost at resale. The average bathroom renovation recoups even less in many markets. You spent $70,000 renovating a home you are leaving, and you recovered $45,000 at the sale. You just gave the next owner a $25,000 gift. The renovations that actually pay off at resale are targeted. Low-cost improvements, fresh paint, updated landscaping, lighting fixtures, curb appeal. Not complete remodels. The people who make money on presale renovations are doing $2,000 projects that return $4,000. Not $70,000 kitchens that return $45,000. Number 9, gifting too much too soon. You think the risk of generous gifting in retirement is that you give more than you can afford. That is not quite right. The actual risk is that you give more than you can afford over a 25-year retirement horizon while making each individual gift look perfectly affordable at the time. You retire at 65 with $800,000 in your 401k. Your kids are in their 30s and 40s. You give your son and daughter-in-law $150,000 toward a house. You fund the grandkids' college accounts, another $80,000. You lend your daughter's husband $40,000 for his business, informally, with a handshake. You have now redistributed $270,000, 33% of your nest egg in the first 3 years of retirement. Each gift felt generous and right. Collectively, they change your retirement math in a way that only becomes visible at 72, when 2 bad market years have hit your portfolio and inflation has raised your cost of living more than you projected. A financial planner I know described a client situation, no names, where a couple came in at 74 in genuine financial distress. They had gifted $400,000 to family members over the prior decade. Each gift was incremental and felt sustainable at the time. Collectively, if those funds had remained invested at a 7% average annual return, they would have been worth approximately $760,000 by the time the couple needed them most. They were now considering moving in with one of the children they had spent a decade financially supporting. The generosity was real. The love was real. The math did not care. By the way, hit subscribe if you like the content. YouTube's algorithm is genuinely brutal, and if you do not subscribe, it may never show you one of my videos again. And I put a significant amount of time into the research behind these scripts for it to just disappear. Now, this is where it gets really interesting. Here is a character I want you to keep in mind for the second half of this video. I am going to call him Gerald. Gerald is not a real person. He is a composite built from conversations, case studies, and patterns I have encountered through years of reading financial postmortems. But Gerald is extremely real in the sense that his specific sequence of decisions happens somewhere in America several thousand times per year. Gerald retired at 64 from a logistics management career. He had $900,000 in his 401k, a paid-off house worth $400,000, and Social Security beginning at 67 at approximately $2,400 per month. By every conventional measure, Gerald was set. Gerald had done the work. In the first 30 months of retirement, Gerald made 6 purchases from this list. I am going to track what each one actually cost him, not the purchase price, but the long run number, because that is where the real figure lives. Number 10, the franchise or business investment. I have 10 plus years running my own business. I am surrounded by accountants and fiscal lawyers. I am not anti-entrepreneurship. I am anti-doing it wrong with irreplaceable capital. The franchise model is seductive for retirees because it comes packaged as a safer form of business ownership. Established brand, proven systems, support infrastructure. And that is true for the franchisor. For franchisees, the data is considerably less flattering. A mid-tier restaurant franchise requires between $500,000 and $1 million in total investment, including build-out, equipment, training fees, and working capital reserves. A service franchise might require $150,000 to $400,000. If this investment fails, and the failure rate for new franchises, once you adjust for survivorship bias and how the industry reports its own success data, is meaningfully high, you have burned through a chunk of irreplaceable retirement capital at an age when you cannot recover from it the way a 32-year-old with no savings could. The math of compounding runs in one direction only. Gerald invested $120,000 in a service franchise in year 2 of retirement. He worked it hard. It did not work. He recovered $70,000 when he sold the assets 18 months later. Net loss, $50,000 plus 26 months of his own unpaid labor during what were supposed to be his retirement years. Everything looks good in the showroom. Number 11, collectibles as investments. Rare coins, sports memorabilia, vintage wine, fine art. These get aggressively marketed to retirees because they combine 2 things that appeal to the newly retired brain simultaneously. They seem like a store of value, and they are interesting hobbies. The pitch is that you are not just spending money on a passion, you are building an asset. The problem is liquidity and expertise asymmetry. If you do not have 20 years of specific domain knowledge in a collectibles category, you will consistently buy high and sell low. The dealer who sells you the rare coin knows exactly what it is worth. You do not. The auction house that takes consignment of your vintage wine charges 15 to 25% buyer's premium on top of the hammer price. The fine art market is opaque, illiquid, and structurally advantaged in every direction toward the galleries and houses, not the individual seller. Gerald bought $60,000 of rare coins from a dealer who presented himself as a retirement savings specialist. The coins were real. The premiums he paid above the underlying spot price for the metals, gold, and silver content ranged from 30 to 40% above spot. He later discovered he could have bought gold ETFs tracking the same underlying commodity for a fraction of 1% in annual fees. 3 years later, he sold the coins through an estate dealer for $39,000, $21,000 gone, plus the opportunity cost of what that capital would have compounded to. Number 12, high fee variable annuities. And here is where we need to slow down entirely, because this is the item on the list where the most retirement money disappears, and the industry is specifically structured to make it difficult to understand why. An annuity is not inherently a bad product. A simple fixed annuity, you give an insurance company a lump sum, they pay you a guaranteed monthly income for life, makes genuine sense for certain situations, particularly someone with no pension and a deep, rational anxiety about outliving their money. I am not here to argue against that product. Variable annuities with living benefit riders are a categorically different product. These are complex insurance contracts wrapped around mutual fund subaccounts, sold heavily to retirees, and loaded with layered fees that are genuinely difficult to locate within a contract that runs between 100 and 200 pages. The average variable annuity carries total internal fees, the mortality and expense risk charge, the administrative fee, the investment management fees on the subaccounts, and the rider fees of between 2 and 3.5% per year. On a $300,000 annuity, that is $6,000 to $10,500 per year in fees, compounding against your balance every single year. Over 20 years, the difference between a 2.5% annual fee load and a 0.1% fee on $300,000, assuming a 6% gross return, is approximately $170,000. Just let that sit for a second. $170,000. Not lost to a market crash, not lost to bad investment selection, lost to fees that were never clearly explained at the time of purchase. Why does this keep happening? Because the commission on a variable annuity sale can be between 4 and 8% of the premium. On a $300,000 purchase, a financial advisor earns $12,000 to $24,000 from a single transaction. And depending on the advisor's licensing structure and the state they operate in, they are not required to disclose that commission amount in plain language. Not required, not illegal, perfectly structured. Gerald put $200,000 into a variable annuity in year 1 of retirement, sold to him by a retirement income specialist he met at a complimentary dinner seminar. He held the product for 11 years before a fee-only advisor finally sat down with him and ran the numbers. The difference between what his money actually earned inside that product and what it would have earned in a low-cost index fund portfolio over the same period after adjusting for the risk-adjusted returns was approximately $92,000. $92,000. That is not a line in the fine print. That is a life. Number 13, switching to whole life insurance. This is the companion purchase to the variable annuity and is often sold in the same conversation, sometimes by the same person, at the same dinner seminar. The pitch: your term life insurance has expired. You are retired. You no longer need the death benefit in the traditional income replacement sense. But what if your life insurance could also be an investment vehicle? What if it built tax-deferred cash value you could access in retirement without triggering a taxable event? What the pitch leaves out, the internal rate of return on whole life insurance cash value is, for most standard policies, between 1 and 3% after the agent's commission. The cost of insurance charges and the administrative fees are extracted from your premiums. You could achieve a substantially better tax advantage outcome through a Roth conversion strategy paired with a low-cost index fund. Every time. The people for whom whole life insurance makes genuine mathematical sense are a specific, narrow group, ultra-high net worth individuals using it for estate planning with a very precise tax strategy designed by someone with a CPA and a law degree working together. If you are not in that specific situation and someone is selling you whole life insurance as a retirement savings vehicle, that is not financial advice. That is a commission in a suit. Number 14, moving to the wrong state. The retirement relocation dream, Florida, Arizona, the Carolinas, Nevada, is not wrong. The tax advantages are real. Florida and Texas have no state income tax. Nevada has no state income tax. For a retiree drawing down a significant investment portfolio and collecting Social Security, these advantages compound meaningfully over time. But there is a version of this mistake that costs retirees significantly, moving based on the tax brochure without running the full cost of living calculation for their specific housing situation. Florida, specifically. No income tax, real and valuable. Also, some of the highest homeowners insurance premiums in the country. Following multiple difficult hurricane seasons, multiple major insurers have exited the Florida market entirely, and the ones that remain have increased annual premiums by 40 to 80% in many areas since 2020. Property taxes reset entirely when you purchase, even if the previous owner had enjoyed the homestead cap for 20 years. And the cost of cooling a Florida home from May through October is a utility bill that many newcomers dramatically underestimate when they are modeling their retirement budget from a different climate zone. Gerald moved to a suburb of Tampa in year 1 of retirement. His homeowner's insurance on a 2,000 square foot home was $4,200 in year 1. By year 3, his insurer non-renewed the policy following back-to-back storm seasons. The replacement policy cost $9,600 annually. His utility bills averaged $340 per month for 6 months of the year. He had modeled $400 per month for the full 12. The showroom version of Florida is palm trees and golf courses. The fine print version involves a lot of insurance paperwork and a very serious conversation with your air conditioner. Number 15, lending money to family informally. I separated this from gifting because it is psychologically different even when the financial outcome is the same or worse. With gifting, you know the money is gone. You have made peace with that. With informal lending, you are simultaneously protecting the asset and protecting the relationship, telling yourself a story where both things survive intact. The loan will be repaid. Of course it will. He is your son-in-law. She has always been responsible. A study from LendingTree found that roughly 57% of people who lend money to family members do not receive full repayment. And the compounding damage is not purely financial. The unpaid balance becomes a source of tension that rewires the relationship permanently. You lose the money, and in many cases, the relationship quality you were trying to protect by lending rather than giving. If you are going to help a family member financially, give it as a gift with clear intent, or structure it formally with a written promissory note, a stated interest rate, and actual repayment terms. Anything in between the informal handshake arrangement with vague repayment expectations tends to cost you both the money and the goodwill. Number 16, prepaid funeral packages from the wrong provider. Prepaying for funeral arrangements is not inherently a mistake. Done correctly, with a reputable provider and a portable, transferable contract, it can lock in current prices, relieve family members of emotionally difficult decisions at the worst possible time, and provide genuine peace of mind. Done incorrectly, it is a financial product with very few consumer protections and a remarkable amount of structural complexity for something that feels like a simple transaction. The problems are specific. Funeral homes are bought and sold with regularity. A prepaid contract with a funeral home that gets acquired, merges with a regional chain, or closes may not be honored fully by the successor, depending on state law and how the pre-need funds were held in trust. Portable contracts, ones transferable to a different provider, are the exception, not the standard. And the upsell culture in pre-need sales presentations can push families toward packages costing $15,000 to $20,000 for services they did not specifically request and would not have chosen independently. Gerald purchased a prepaid funeral contract for $12,000 from a local funeral home in year 1 of retirement. 3 years later, that funeral home was acquired by a national chain. The contract technically remained valid. The services he had selected were restructured under the new management. He spent 4 months dealing with paperwork on a product he had purchased specifically to never have to deal with paperwork on again. Number 17, expensive anti-aging and luxury medical treatments. I want to be precise here because I am not arguing against investing in your health. I am saying the longevity and anti-aging industry is specifically designed to extract money from people who have recently retired, are thinking about mortality in a focused way for the first time, and have a lump sum available that they are now, finally, permitted to spend. Stem cell therapies marketed as joint regeneration, hormone optimization clinics, IV vitamin infusion protocols, hyperbaric oxygen chambers marketed for cognitive enhancement, longevity supplement stacks running $400 per month. Many of these products and services exist in a regulatory space where the health claims cannot be fully substantiated under FDA standards, the peer-reviewed evidence base is thin to non-existent, and the pricing is set by what the affluent retirement market will bear, rather than by what the treatment actually delivers in measured outcomes. This is entirely different from evidence-based preventive medicine, regular screenings, structured exercise, evidence-based nutrition, mental health care, medications that your actual doctor prescribed after a clinical evaluation. Those are worth every dollar and more. The distinction is whether there is rigorous, peer-reviewed evidence behind the specific treatment, or whether a wellness clinic is monetizing your anxiety about aging with a product that looks very good and you already know the showroom. Now, let me give you the full Gerald ledger, because I promised I would track it. Gerald started with $900,000. The variable annuity, $200,000 deployed into a high-fee product. 11-year opportunity cost versus a low-cost index fund, $92,000. The coin collection, $60,000 in $39,000 recovered. Net loss, $21,000. The franchise, $120,000 in $70,000 recovered. Net loss, $50,000. The Florida insurance overruns, utility overruns versus his model, and unexpected carrying costs from his choice of home. Approximately $62,000 over 8 years beyond what he had projected. The informal family loan that was not repaid, $40,000. Prepaid funeral contract complications and remediation, $8,000 in additional costs. Total documented loss across 6 categories, $273,000. Not from market risk, not from bad stock picks, from 6 items on this list, each of which looked completely reasonable on the day Gerald said yes. Gerald is 75 now. He is okay. He is not the worst version of this story, but he is also materially more financially constrained than he expected to be at 75. And the gap between where he thought he would be and where he actually is, that gap has a very specific address. It lives in 6 showrooms he walked through in the first 30 months of retirement. Here's the framework. 3 levels, 3 questions. In this exact order. Level 1. What is the all-in annual cost of ownership? Not the purchase price, not the sticker, not the monthly payment, not the down payment. The total annual cost, including maintenance, insurance, property taxes, fees, and the opportunity cost of the capital deployed. What would that money have returned if it stayed invested at a reasonable long-term rate? This one question eliminates the majority of the bad purchases on this list before they happen. Level 2. What is my realistic usage rate versus my projected usage rate? Every bad purchase on this list came with an optimistic usage projection. Model the realistic version, cut your projection in half, and ask whether the math still works. If the product only makes sense at your optimistic usage rate, it does not make sense. Level 3. Who profits from me making this decision and how much? This one matters most on the financial products side of the list. If the person presenting an annuity, a whole life policy, a timeshare, or a pre-need funeral contract earns a commission from your purchase, they are not a neutral advisor. Their incentive is misaligned with yours by structure, not by character. Get a second opinion from a fee-only fiduciary who charges a flat rate and earns nothing from your specific product choices. Let me give you one specific scenario, so this is not abstract. You retire at 63 with $600,000 in your 401k. You take Social Security at 62, getting $1,800 per month. Your expenses are $4,000 per month. You are drawing down your portfolio by $26,400 annually, roughly 4.4% of your initial balance, which sits at the edge of the conventional sustainable withdrawal zone. In year 1, you put $200,000 down on a vacation home. You finance the rest, annual carrying costs on the property, $14,000. Annual mortgage payment on the finance portion, $11,000. You are now pulling $25,000 per year from savings just for the vacation home, on top of your existing drawdown. Your total portfolio withdrawal rate has essentially doubled. A Monte Carlo simulation, the kind institutional retirement planners actually run, would flag this plan as having greater than a 60% probability of running short before age 85. You bought a vacation home with capital that was structurally protecting your retirement, and it looked completely reasonable in the real estate agent's office on a sunny Saturday in April. The version of this story that ends better. You do not buy. You rent in the places you love for 3 to 4 weeks per year at $2,500 to $3,000 per week for a premium rental. That is $7,500 to $12,000 annually, less than the carrying costs alone on the owned property. Your portfolio stays intact, your withdrawal rate stays sustainable, you are not responsible for the plumbing at 3 in the morning. And you can try a different location every year until you find the one you actually love, rather than the one that looked good in the listing photos. A financial writer once described the timeshare presentation room as the only place in America where the phrase, "just imagine," does more legal work than an actual contract. Just imagine waking up here every summer. Just imagine the grandkids running on this beach. Just imagine having a place that is truly yours. The sentence they skip is just imagine running the actual numbers. Here is what runs underneath all 17 of these purchases, and it is the thing worth sitting with. Retirement breaks the psychological operating system you spent 4 decades building. That system ran one program: delay gratification, be responsible, think in decades. It served you exceptionally well. And then on one specific day, you are told that the delay is over. The saving chapter has ended. Now it is time to enjoy it. Your brain, which has been running the delay program for 40 years, has genuinely no idea what enjoy it looks like in practice. So it reaches for the biggest, most visible symbols of enjoyment it can identify. The vacation home, the boat, the country club, the dream car. These are not random impulses. They are the cultural symbols of financial arrival that you spent a lifetime deferring. They are what success was supposed to look like from the outside of it. The retirees who navigate this best are not the ones who spent less. They are the ones who learned the difference between the symbol and the thing itself. The boat is a symbol of freedom and time on the water. But freedom on the water is available through a boat club, a charter, a friend's dock. The vacation home is a symbol of having somewhere that is yours. But that feeling can be rented. The country club is a symbol of belonging somewhere. But belonging can be found in a lot of places that do not charge a $50,000 initiation fee and a $12,000 annual commitment. The symbol is always more expensive than the underlying thing. The showroom sells symbols. Lazy investing built more fortune than crypto memes. And here is the genuinely cynical footnote to all of this. The people who sold Gerald every item on his list are still out there. Different Gerald, same list, same showroom, same dinner seminar with the free steak and the annuity brochure. The incentives have not changed. The marketing has not. And retirement, that specific moment of psychological vulnerability dressed up as a celebration, keeps happening every single day to the roughly 10,000 Americans who turn 65. The only real defense is knowing what is in the showroom before someone hands you a glass of wine and walks you toward the signing table.